And on today's show, moving middle America to tax advantage strategies. Part 5 of this week's series on marketing to middle America with top of the table and Forum 400 producer Jim Silbernickel. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician in Innsmouth. Let's get down to business. Well, welcome to Friday. Wow,
yeah.
Jim, 5 days in a row. How you doing?
I'm hanging in there.
You're making it. Well, if you've missed any of our shows, we've been talking with Jim. Why are we talking to Jim about this? He's a top of the table, Forum 400 producer, lifetime MDRT member, and he lives in a small town in Wisconsin, and he's doing serious numbers with a very unique practice. And many of our guys are going to, I know I'm going to get email on this. How does Jim do this? Well, we're talking about it all this week on how you do it. Now, you're introducing your clients to some of the tax advantages in the insurance industry that really they may not have been acquainted with before. Right. When I'm looking at some of these things, like for example, before I get into, I'm going to save the qualified money maybe to a little into the segment, but when I'm looking at basic ideas that you're introducing, I saw one of the tax advantages you brought in, I'm thinking, you're talking to some farmer about an oil and gas lease project. Yeah. Tell me how that goes, because that seems a little sophisticated for a regular guy.
Well, it's actually pretty easy with farmers because they're used to buying seed and planting it, and then they know what the harvest is. You know, once you harvest the crops, you're done. Okay. Well, it's the same thing with an oil and gas partnership. You're buying the oil in the ground, so you're planting seeds and you're harvesting, and there's some significant tax advantages. So I've always looked for areas where it's unique. Now that's a tricky area, and compliance has a lot to say about it, but it is a great planning technique.
Talk about regular CRT, these charitable remainder trusts. How big is that in your practice?
You know, it was huge when capital gain rates were higher. Then it tapered off a little bit, and now it's back to being big again. And the thing is, one thing we had to do is find a way to make this cost efficient for our marketplace. I've talked to some organizations where the attorneys would charge $15,000 to draft the documents, and then it was 1 or 2% cost and $5,000 administration fees and all that stuff. Well, that works great when you're dealing with millions. When you're dealing with hundreds of thousands, the bang for the buck gets lost. So we've partnered again with attorneys and CPAs that understood how to do this. We made ourselves very cost effective, and the CRTs, for those that don't know what a CRT is, you owe it to yourself to get familiar with this, and donor advised funds and things like that. But what it allows somebody to do is avoid the capital gain on a sale. And dealing with farmers, everything goes into that farm, and they might have $500,000 of equipment, and when they're ready to retire and sell it, that's depreciated assets taxed at the full rate. Well, right now we have 39.6 plus the 3.8 Obamacare tax. In Wisconsin, we have 7.7 top state rate, and you add that all up, and they could be losing 51 cents on the dollar at the high end. Well, by using a CRT, we can avoid the capital gain and preserve the economic benefit because they get the cash flow from the proceeds. And with that tax deduction, we might just be able to do some Roth conversions. So it's what it can do for them. Not so much just what that is, but what it can do for them that makes it so powerful.
I'm going to just pose this question to you, Jim, just to see your take. We are doing a ton of Roth conversions right now. Bracket bumping, strategic placement, how much can I amortize over to keep within the bracket? Okay. I'm wondering if we should have been in the qualified market to begin with. We're doing so many conversions, right? Should we have even been in qualified plan at the get-go?
Well, you know what? It really depends on the circumstance. I mean, I'm talking to clients every day whether they should do Roth or traditional. And we're making that decision.
At the beginning.
Yeah, we're making that decision every year. So like when we're delivering those tax returns that we talked about, we're looking at where they're at. Should they be doing a Roth contribution? But, at the end of the day, it depends on the client. Do they feel tax rates are going to be higher or lower? Just because tax rates are higher doesn't mean their rate will be higher. Because if they're doing a poor job for planning for retirement, they might be in a 0% bracket when they retire. So everybody is a little bit different. And since Roths have come out, I'd say they're probably one of the biggest things in our practice, because it's only lately, in the last year or two, where people are all of a sudden talking about bracket bumping and all these issues. We've been talking about that since Roths came out in '96. In the first year, 97, we had the chance to Roth convert over 4 years.
Yeah, I was thinking if you're looking at qualified plans, and I'm in Middle America. Now, if my employer's matching it, I'm doing this all day long.
Oh, absolutely.
I'm doing this all day long. But let's say I'm not matching it. And by the time I look at my effective marginal tax bracket, taking my exemptions, deductions, credits back to me, and I might be sitting at the 20% tax bracket. I'm just wondering, I'm putting $1,000 in my qualified money. I'm wondering if I should have just went right to Roth from the day one. As a Middle American.
Yeah, I'm telling my clients now, if they're getting started early and saving and they've and they're on track, okay, I'm telling them 15% bracket, let's do Roth. You get into that 25% bracket. In Wisconsin, we got pretty hefty state income taxes as well, so that's an issue. So we're looking at it, and again, I let the client decide because here's what I would do if I were you. But you know what? You have to decide whether you want to pay the tax on the seed or you want to pay tax on the crop. And taking a chance where rates might be in the future. So, and the other thing I emphasize with all that, like it's important to diversify where your money's invested, I think it's just as important, if not more important, to diversify how it'll be taxed.
When we come back from the break, we're going to continue this Middle America mindset thinking. We're talking about tax advantages, touching on certain things, to tax or not to tax. We'll be right back after the break. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, welcome back to the second segment. Jim, I want to talk to you a little bit about 401ks, defined benefit plans, the potpourri of the tax deduction. Again, I just want to be on record. If my client's in a high marginal tax bracket, and especially if his employer is matching it, I'm all over that. I'm in 401k land.
Yep.
I'm going to be doing it. But do you see any one of these being more advantage of a not? If I already said in my mind, my client says, I do want the tax deduction, whether I think it's valid or not.
Yeah.
Any better? You like 401ks over SEPs, over IRAs?
I like the 401k, especially since the Pension Protection Act passed and we got the UniKs. I've found some very cost-effective ways for people to do the 401k. And what I like so much about the 401k is the flexibility. We can do internal conversions if the opportunity presents itself. We can do Roth or traditional or a combination thereof. And then with the profit-sharing portion, get a lot more money in if we need the deductions. We can even create a money purchase or defined benefit situation where a lot of money can go in. Now, in my marketplace, I'm rarely talking about defined benefit because my clients aren't making the kind of money to justify that. Usually the 401k will take care of any deductions we want to create for a small business. Now, the simple plans, I like the simple plans simply because, if they've got some employees and have some issues there, it's a little bit less expensive because once you start having employees and you got to do all the testing and discrimination rules with the 401ks, it starts to get kind of expensive for a small business. Plus, a lot of 401ks need a certain amount of cash flow, so it's maybe a little bit beyond their reach. The SEP, for someone who's self-employed, usually that's a nice thing for someone who doesn't do any planning and comes in on April 10th and says, oh my God, what do I do for my taxes? But understanding all those, and that's where, again, we try to train our clients in a sense. Here's the signpost. Here's the warning signs. Here's the dates you need to call me by. I'll follow up with you on this date, but we need to start to make decisions because they all have different deadlines in order to take advantage of them.
Now, I noticed that you have a nice size population of small business owners in your area. And you're really into looking at how to harvest business losses and business profits. Talk a little bit about that because the small business owner, the entrepreneur of America, the backbone of our entire culture, our economy, is really, I don't think they're up to speed on this.
Well, and most of our small business owners are making maybe 50 to 100 grand. So when I talk small, they are small.
Small, yeah.
They are very small. But, the old days of income averaging are gone. But, you can use the retirement plan to kind of income average. And I'll describe this by just telling you a story. I had a client that came in. He was in the heating and air conditioning business. And I have been trying to get a hold of him to review where he was at, because he actually turned his heating and air conditioning business over to his sons and started a pellet business, these stoves that work on pellets for heating. So he didn't want to talk to me, and I couldn't figure out why he didn't want to talk to me. And he came in to meet with the CPA that's in our building, and my CPA said, "Is there anything you need to talk to him about?" So, yeah, I went over there, said hello. He's like, "Jim, we don't have any money to invest today. So we just, business isn't that good. They're maybe a little embarrassed about it." And I said, "Well, so you got a few lemons, did you?" And he's like, "Yeah." I said, "Well, let's make some lemonade out of that." And I said, "What kind of losses did you have?" And he talked to the accountant. The accountant said, "Well, about 70,000, because he had a lot of startup costs." Well, we took 70,000 of his IRAs, converted it to a Roth, didn't pay a penny of tax. Now we got 70 grand growing tax free. Next year's business takes off. We set up a 401k, and we need about 30,000 of deductions. Next year, we put in a deductible IRA, or a deductible 401k. So we've had the opportunities to manage their net taxable income by using those tools.
Well, just this one idea that you just said could be powerful for an advisor, because the client said, "I'm not going to go to Jim because I have nothing to give him."
Right.
Our art form, the art form of our practice, is to discover where money is.
That's right.
And to free it up and to pay less in taxes. I mean, this guy would have, if I hear you correctly, if he did not meet with you, he would have went forward, had already experienced the losses, and he still had to pay tax.
That's right.
He couldn't take anything out of his IRA.
Well, he didn't have to pay tax that year, but we still didn't have to pay tax, and now we had 70 grand growing tax free. I mean, it's just so powerful. Right. And how many advisors out there, if you're not looking at their tax returns, you're missing just an unbelievable amount of opportunities. And business losses is one of the things, because the CPAs aren't talking about it. They just say, "Well, you got this loss and you'll carry it forward." Well, if they never turn a profit, if the business goes out of business, what are you going to do with those losses? They're just gone. So you have some opportunities, and sometimes it's a use it or lose it type opportunity that you need to jump on. And if you're not on top of that by year end, the opportunity might be missed.
Some of the tax issues that we're talking about, you can have this going out to Backroom Technicians 30-day free trial if you don't have it. And it really has really great documents to walk you through it. And when you're talking to young advisors who are just learning this name of the game, which is tax advantaged products and tax ideas and strategies, this has been huge for your practice.
Oh, absolutely. Focusing in on that. And one thing I got to emphasize to all the advisors out there, collaborate with people. Don't try to do it all yourself. This 100% of nothing gets you nothing.
Right.
If you share the revenue with someone who's doing it every day and learn while you earn, I mean, don't be too proud to bring some other people in that if you're not an expert on it yourself. But in the meantime, continue to educate yourself. I mean, we've got things like NAFA, MDRT, all these places where you can learn these ideas. And I know you've had some great guests with Tom Hagna and Curtis Cloak, just to name a couple, that are really on top of the tax planning income game, which is where it's at. With all these baby boomers, 10,000 a day retiring, they all need help.
They all need help. Well, thank you so much, Jim. Well, that's our show for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just hop out to our site at downtobusiness.ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant. We'll see you next week.